Welcome back to the panel discussion at this Asia Voices Perspectives on Tax Policy virtual seminar on the globe rules and its impact on Asia. This panel discussion will run for about an hour and a half. And please, as before, please pose your questions or comments for the panel through the Zoom Q&A function at the bottom of your screens. The session will be moderated by Mr. Michael Velten, who is a financial services tax partner with Deloitte Singapore and is the firm's Southeast Asia financial services tax leader. He's also a member of the Asia Voices Working Group, and I'm pleased that he is able to moderate the session today. Michael, over to you.
Thanks, Chris, and welcome back, everybody, and welcome to the panel joining us for this session. It's a diverse panel, and obviously we're looking to build on the discussion of the speakers prior to the break. So joining us today, we have Panayiotis Nicolaides. Panayiotis is Director of Research at the EU Tax Observatory. His research focuses on tax evasion and tax avoidance, and he has extensive experience in high-level policymaking in the European Union. We're also joined by Bruno Casella. Bruno is a senior economist at the United Nations Conference on Trade and Development's Division of Investment and Enterprise, where he leads the Intellectual Property and Development Unit. Next, and I'm just trying to match my notes to who I see on the screen. Next is Samantha King. Sam, welcome. Sam is the Global Head of Tax at Standard Chartered Bank. She's based in London, so good morning, Sam, and leads a team operating across 15 countries, comprising country, functional, and process tax specialists. Sam is a qualified tax accountant and chartered tax professional, and we'll be bringing a multinational perspective to the implementation issues, which we started to touch on in the previous session. Adding to the multinational sort of viewpoint, we're also joined by Vaibhav Sanghvi. Vaibhav is Senior Director of International Taxation at NortonLifeLock. Vaibhav is responsible for worldwide tax planning, managing operational taxes and strategic tax projects across EMEA, APAC, and LATAM. So kind of very diverse kind of focus in his role. He has over 25 years tax experience in international tax and planning. We hope also to be joined a little bit into the session by Professor Thabo. Taba is a professor in the Mercantile Law Department at the University of Johannesburg in South Africa and teaches tax law. Prior to being an academic, Thabo, like Sam, was a bank tax person. He was head of tax for Africa for Citibank. He's also the acting tax ombud in South Africa, in the South African office of the tax ombud. So the introduction's done. The way we thought we'd proceed with this segment is that each of the panelists will share their perspective, not just on the issues raised in the paper presentations and Jay's keynote, but how the rules impact them, how they see the rules from their perspectives, and hopefully with the diversity within the panel, we're going to get a range of perspectives. So each of the speakers will spend 5 to 8 minutes or so sort of sharing their viewpoints. And then from there, we'll sort of look to have a discussion around some of the themes that sort of come not just from their comments, but from the earlier papers. And as Chris has mentioned with respect to the previous discussions, please feel free to add your comments, ask questions, and take advantage of the panel we've assembled today for this final session. So with that, I think we'll kick off with Panos for his perspectives. And then sort of after that, sort of Bruno, and we'll continue from there. So Panos, welcome. Look forward to your views.
Thank you, Michael, very much for the introduction. It's a pleasure to be here from an early morning in Paris, and a pleasure to join the panel with the distinguished panelists. The perspective that I would like to bring is more the academic and the internationalized perspective, and giving you the big picture that comes from data, the academia, research, and what countries, how countries view the upcoming reforms. Firstly, we have seen in the past decades the rise of the multinational company, and the multinational company resulted in shifting profits. Zuckman and Torslov in a recent paper in 2022 have estimated that about 36% of profits of multinationals has been shifted, and this is an upward trend. Low tax jurisdictions especially attract sizable amounts of profits from these multinationals that are taxed at very, very low rates. The baseline estimates are in the orders of trillions, and for Singapore, for example, the country that the conference today takes place, has been estimated to be about 70 billion that has been shifted in 2015, according to the latest estimates. What has explained the rise of the profit shifting that we've seen? One is countries. Countries over the past few years have competed in statutory corporate tax rates, which have halved since the 80s, from 49% to 24%, and continuing to be lower with a lot of variation, of course, some distributions close to zero. The decline that we have seen is it cannot be compared to other tax rates that exist, for example, in labor. There has not been any similar decline in any other corporate tax rates, in any other tax rates. But for corporations, the decline has been quite remarkable. Why countries do this? They compete to attract business and capital, of course, as to stimulate growth. However, the literature does not find a strong link between growth and falling tax rates. What we find instead is a rise of inequality, because the equity structure is concentrated heavily at the upper end of the income and wealth distribution. So equity ownership is concentrated, and profit shifting reduces the effective tax on the wealthy. This is what comes from the literature. Low tax destinations essentially facilitate that. So one is countries, and I've talked only about statutory tax rates. When we go to effective tax rates, this is even lower because of the numerous schemes that have been introduced. The second is the mode of production that has been going on in different countries over the past few years, and facilitating the rise of the multinational, the globalization, and digitalization trends. The ways goods have been produced and services have been offered in the past few years have dramatically changed, especially when we compare them 100 years ago, when the old set of rules was decided, how companies are taxed. Production today is more dispersed. Consumers are located in a number of countries. And the companies have become, over the past 2 decades, a lot more digital. So it's very easy to be based on one location, have your customers in other jurisdictions. And of course, taxes and policy on taxes, the countries have not responded to that yet, because it needs a multinational coordination. And only in the past few years in the BEPS OECD procedure, these rules have been discussed. My point being, what we will see, the new rules, is an unavoidable process, and is a policy response that has been significantly delayed over the past few years. Let me make a stop here and let others make their points as well. But this is the big picture that comes from academia.
Thank you, Panos. Bruno, you've got a very investment and trade sort of focus. I mean, very interested to kind of get your reactions to Panos, but also your own perspectives around the impact of Pillar 2, particularly on sort of future investments and trade flows.
Sure, Michael. Thank you very much for the introduction. Yeah, first I would like to thank Christopher and the Institute of Policy Studies Singapore to invite me, and it's very interesting discussion. As you were saying, Michael, my background is on investment. So with my division, what we do is trend and policy studies on FDI, foreign direct investment to developing countries. So I think it would be useful to highlight why we think that the international tax reforms, and in particular the global minimum tax, is really important for FDI and for FDI to developing countries. And it's so important to the extent that we decided this year to dedicate a thematic chapter of our annual World Investment Report to the implications of the global minimum tax on FDI. So yeah, in the report you will find a lot of discussion and analysis about that, well beyond what I can summarize in my short intervention. But let me try to give you an overview. So the trivial answer why it's important is that it's taxation on FDI. So it's taxation on income generated by FDI, so by the foreign operation of potential enterprises. And you know, there has been a lot of controversy on whether tax is or is not a driver of investment decisions of multinational enterprises. But if we look at FDI across the last 30 years, both from a data trend and the policy perspective, there is little doubt that taxation has been one of the factors shaping the FDI landscape. If we look just at the last 7 years, two editions of the World Investment Reports had a thematic chapter, international taxation and FDI, in 2015 at the beginning of the BEPS process, and now in 2022. So clearly a reform that is going to affect so profoundly and to some extent radically the taxation of FDI income is expected to have a major implications on FDI, and it will do so because it's expected to transform the way MNEs invest internationally, one way or another. And I would like here to highlight three possible ways, and I will list them according to what is my perception of the degree of impact on investment. So the first is the most important, I think, and perhaps the most obvious. It's going to affect tax competition for attracting foreign direct investment. So what really the minimum does is really mechanically compressing tax differentials between countries, no? with ranges of effective tax rate applied by host countries that goes not anymore from 0% to 30%, say, but now from 15% to 30%. And so in that context, what we expect is that taxation will be much less of a driver of investment decision of multinational enterprises. And this is a huge change, a massive change. And the change at institutions like the one I represent, but others as well, the IMF, the OECD, have been advocated for a long time. And now with the minimum tax, there is a real opportunity to realize that at scale. So the actual potential, disruptive potential of the minimum on tax competition is still difficult to anticipate, because it will also depend on some mitigating factors that are actually embedded in the reform. Maybe we have spoken about that before. So first of all, the level of the minimum, 15%. For some countries, this is perceived to be too low to really affect tax competition, meaning that MNEs already pay more than most of the MNEs already pay more than 50%. And then Pillar 2 is also selective. It does not, that's the second factor, it does not affect the same way all the tax incentives. So countries, they still have quite a lot of degrees of freedom in setting incentive policies to attract FDI. And then there is the third element, which is the substance-based carve-out, which basically set up a window that just capture a share of the income, but still where countries can still apply the tax rate they want. So a window for tax competition. So it will depend on several factors, but overall it's a big change. The second big change is the impact on profit shifting, so assuming that also investment and profits reported in offshore financial centers will be subject to a minimum of 15%, so there will be much less of an incentive for multinational enterprises to shift profits from host countries where operations take place to offshore financial centers. And I'm quite positive on that in the sense that I think that with a 15% minimum, so a 15% minimum is sufficient to significantly disincentivize MNEs to shift profits to offshore financial centers. And this does not just meet a general need for fairness in the global tax system, by which you need to pay taxes where you generate revenues, but it's also expected to redesign the global FDI network. We know that 30–40% of FDI globally are channeled through offshore financial centers. And this channeling is largely instrumental to profit shifting dynamics of multinational enterprises. So to the extent that the minimum is gonna significantly decrease profit shifting, it will also decrease the amount of investment that are channeled to this conduit, and it will significantly redefine the geography of global FDI. And then we come finally, as the last point, to the third element, which is probably the most controversial. To the extent that the global minimum tax is gonna affect the cost, it's gonna increase the cost, the fiscal cost of investing, it may have an impact on the total volume of investment. So it may decrease the propensity of investors to invest. So it may decrease the size of the pie. It doesn't really work, as we know, like in a shop where, you know, if the cost of the apple increases, I buy less. There are things in taxation like average tax rate, marginal tax rates, and it's the marginal that affects the volume of FDI. But still, we can. It's fair to assume that multinationals factor in taxation in their investment plan. So these are the three elements. So the first element is the impact on tax competition. The second element is the impact on profit shifting, and the third element is the impact on cost and volume of FDI. Now, if we put together all these elements, we can understand that it's quite a earthquake in the world of FDI, and that's the reason why in our World Investment Report we decided to dedicate the thematic chapter to this issue. And I stop here. Thanks.
Thanks, Bruno. Professor Taba still hasn't been able to join yet, so Sam, maybe if we could turn next to you for your perspectives, and obviously, you know, bringing with it as you do a multinational kind of lens of operate and one where you're operating globally. So.
Thank you, Michael, and thank you to Chris and to the panel for inviting me to speak at the event. So my previous two co-panel members have talked sort of quite extensively and probably more eruditely than I can on the overall policy objectives of the global minimum tax and why those make sense or not from an investment perspective. So maybe I will limit myself to 2 comments on the sort of broader policy. The first is that when I think about the global minimum tax regime, I think of it as, if you like, a huge CFC regime, so a controlled foreign company regime, but one that, in addition to sort of replicating what a domestic controlled foreign company regime might do, also is able to handle inversions. So inversions in this context being when a group moves its top company to typically a lower taxed location to avoid CFC regimes. And so for me, that's what the global minimum tax sort of achieves as a policy tool for countries. If I then look at that for a globally regulated banking group, an inversion changes the lead regulator of your group or impacts the choice of the lead regulator. So there are really multiple commercial and regulatory considerations which already effectively control whether a global banking group would indeed invert. So looking at it from an industry perspective, global minimum tax is a very large hammer to use a very large hammer to crack a nut that may or may not exist. That said, I can see that doesn't apply outside of globally regulated organizations. Second comment from a policy perspective is really whether there is the opportunity to link 2 major global initiatives. So we have the global minimum tax regime. We also have the journey to net zero. And I do wonder whether there's an opportunity to link those and to effectively allow incentives that drive us towards net zero from a climate perspective, to allow those incentives in the global minimum tax regime. I think not likely to happen anytime soon, because I think an early policy choice in global minimum tax was actually to avoid sectoral incentives. And it's quite hard to design a regime designed to take us on the journey to net zero without having some elements of sectoral views. But I do wonder, if we look over a longer time horizon, whether those 2 policy tools could effectively be brought together to therefore maybe create a more positive purpose for the global minimum tax than the perhaps slightly negative perception it comes with today. So those are 2 comments on the policy aspects. Maybe now go on to what Michael asked me more directly to talk about. So if we take the policy objective of flooring corporate tax competition between states as a given, and then look at how proportionate the execution is. So in any legislation, guidance, etc., you have a trade-off between simplicity and therefore the amount of compliance costs, and complexity, or in effect the accuracy with which the legislation implements the policy objectives. When I look at what I think good sort of policy implementation involves, it involves having legislation that accurately represents the policy objective, and then trading off that complexity through things like safe harbor tests. One observation I have about the global minimum tax regime is that some of that complexity has been traded off in the legislation itself. And I think that will cause problems as we start to implement this over the coming years. So what are kind of my bright lines on that? Well, I guess one point is a regime that is designed to ensure we pay a minimum, globally a minimum tax of 15% is paid, should not exacerbate double tax. It should erode double non-taxation, but it shouldn't exacerbate double tax. And I think there are a number of items within the regime where that trade-off has been made to say we'll go for something simpler, whether on the transfer pricing rules or on how losses are treated, but in a way that will definitely create double tax in certain commercial considerations. Second point really is around how a regime handles stress. So it's important that you accurately achieve your policy objectives when organizations are making profits. It's even more important that you achieve them when organizations are under stress. You do not want to exacerbate a financial stress by charging someone tax at the point, additional tax at the point that they're in the middle of a financial stress, because that has much broader prudential regulation and also economic consequences for bankruptcies, etc. The way the rules at the moment work on losses, and I am confident that the OECD will fix this, but the way they work at the moment on losses, effectively, if you hold government bonds, which is a requirement for a banking group, we're required to hold high quality liquid assets. If you hold exempt government bonds and you suffer a period of financial stress, the legislation wants you to pay tax on the impact of those government bonds, which you won't have had any benefit from because you've just made a huge loss, but it wants you to pay tax on the future benefit that you might get from the loss relating to the exempt bonds today. So that is a very poor piece of sort of match up between the policy objectives of the global tax regime and the policy objectives of global regulators and prudential policy. And I think that if you sort of play that forward, I think that's an area where, for me, the consultative process hasn't worked as well as it could. So when you have legislation of the complexity we have here implemented domestically, there's generally a very close engagement between the regulators and the tax policymakers to make sure those things are balanced. And I think that's an area where voices from Asia, from the rest of the world, could have been more effective in influencing the policies that we've got. Final comment on the implementation. The other sort of area that concerns me about how the rules are currently implemented is the volatility of them. So whenever you trade off simplicity and complexity, you really need to scenario test it for a different set, for the economic results that you might pump through. Again, this is particularly relevant for the banking industry, but I think it applies more broadly. The relevance of the banking industry is that our accounting rules tend to mean that when there is a macroeconomic stress, whether that's COVID, whether that's global political outcomes of the Ukraine-Russia situation, when there's a macroeconomic stress, the way the accounting rules work for a bank is it tends to make you make a loss, and then in subsequent periods you may make a profit. So in effect, the present value of all of the future economic events are present valued and put through your books in the current period. What that means is that your financial outcomes tend to be quite volatile period on period, and therefore the fact that, as currently written, the carry back, carry forward rules don't work brilliantly is a significant concern. So I think maybe if I therefore summarize on that point, I would like to see a better trade-off between complexity and simplicity. I would like the rules to actually achieve the policy objective and then trade off the complexity with a safe harbor set of rules. And I'm not sure that's where, I think that is better policy design. And I'm not sure that's wholly where we are today. Thank you, Michael.
Thanks, Sam. Last but not least, Vaibhav, your perspectives.
Right. So thanks. Very honored to be on the panel and be with all you guys. So thank you for this opportunity. I work for Norton, which is now called GEN, which provides software and technology solutions to our users so that they can live their digital lives in a safe and secured manner. It's a US MNC. We operate in a number of countries. And with that comes the issue of how do we manage these changing regulations, country by country at a global OECD level. And from an internal tax department perspective, how can we bring value to the business? How can we update our management and our board as to what is the potential impact of these new changes, of these new taxes? Is it going to increase our effective tax rate? by 1 or by 2 percentage points? Is it going to bring more complexity? Whether it's going to lead to double taxation. So I think what we prefer is kind of a consistent approach in the rules and its implementation. And I can tell you that technology software companies are changing their business models all the time. We have to adopt and adapt our offerings and technology solutions to to changing requirements from the clients from an innovation perspective. So how can we, from a global tax department perspective, bring about certainty in planning, in forecasting, and how can we bring strategic oversight? Second point is in terms of the US regulations. Now, clearly, we have heard over the last few hours on this session that the US regulations are not in sync with what the Pillar 2 model rules look like. Prime examples are the Common Alternate Minimum Tax, which got introduced just in August under the Inflation Reduction Act, which also is at 15%, but it is not a Pillar 2 tax. So how do you make that in sync with the Pillar 2 rules? The second aspect of it is with respect to the foreign tax credit regulations in the US. That's very important for us to see whether the foreign taxes that we are incurring, do we have the ability to claim credits or not? With these kind of rules and different adoption of it in different countries, do we have the ability to claim a credit for these taxes? And that boils to the point of, is this going to result in double taxation? There could be a lot of friction between the OECD model rules as well as the domestic top-up regimes as to how they could be implemented. So we do anticipate and foresee a lot of tax disputes, and the unintended consequence of this could be having double taxation, getting taxed in the source country, not getting credit back. So that's something to kind of look into. I will now get into the computational aspect of Pillar 2. Unlike many current tax systems, the Pillar 2 minimum tax is going to be determined based on book income. So you have your pre-tax results, and then you have a lot of adjustments, to compute what your effective income under the GLOBE rules should look like. There could be a lot of adjustments, right? There could be transfer pricing adjustments. There could be IP transfers that will need to get adjusted out. Many other operational accounting adjustments that will happen. So our companies set up to do such complex calculations. It will require new processes. It will require some controls, some systems, some education internally, between our finance, accounting groups and the tax groups. So a lot of computational aspects, and to that point, also our ERP systems, they are not designed to throw out such calculations in a very quick and a very nimble manner. So that will require a lot of data challenges, accounting kind of massaging around that numbers, and that's where I foresee a lot of work or additional resources will be required to get this done. My next point could be, how are these domestic top-up taxes going to be administered? Now, that's a pretty challenging question that we're going to get into, because we talk about top-up tax as if it was a very universal single-level calculation, but it's going to be administered in many different manners. And that's what is going to create the complexity. Is it countries which are going to implement minimum taxes to apply to their own domestic taxable income, so they can collect and administer the taxes through the QDMTT? What if there is no QDMTT, and under the model rules, say for a US headquarter company, you can address it through the income inclusion rules? And if you don't have the model rules, you don't have a QDMTT, then you go into the very complex under tax payment rules. I'm not going to get into the depth of it, but just talking about it, just thinking about it, practically throws up a lot of challenges for our taxpayers, for internal tax departments, and a lot of work to be done. So if I were to just kind of summarize what are the main challenges, we want to ensure that we don't get into a double taxation scenario, because it is looking more and more like it seems like a double tax. The credibility, the creditability of the foreign top-up taxes which are paid under the domestic top-up regime. Second point could be on the dispute resolution framework. Are we going to have a mandatory mechanism which will help us much more than what a mutual agreement procedure would do for us currently? Thirdly, on the compliance process, that seems pretty complex, to manage this. Data transformation, systems, processes, again, a challenge for companies. And hopefully this new international framework does not hinder economic growth. That I'm sure governments, tax administrators would not want to see, simply because we are in a very uncertain economic environment. Do we think we are in a recession? Maybe not. Do we think we'll be in a recession next year? Probably. So do we want companies to grow investments, to create employment opportunities, and to set up their regional base, the regional headquarters, the global hubs that we are positioned in Singapore? So those are my kind of collection of thoughts from a very industry level. Sorry to throw up more challenges than solutions.
No problems at all. Thank you, Vaibhav. As the panelists have been talking, there's been a bunch of questions come in, and in addition to the questions that I think Chris and I had sort of each had. But maybe to start with, take them in order in which they've come. And there was one from the floor. And Panos and Bruno, you might be able to see this in the Q&A box. But for Dr. Panos, Dr. Bruno, thank you for sharing your insights. The need for BEPS to update the international tax rules to cope with globalization, digitization, and the resultant behavior of global MNEs is well articulated. However, with the tide of globalization and free flow of FDI capital challenged with decoupling, more nationalistic policies from friendshoring to subsidy of chips and EVs, how do you see the BEPS's aims of harmonizing international rules interact with those forces of fragmentation?
Yeah, thanks a lot for the question.
Yeah,
it's very, very interesting and a very good question. I think what the Pillar 2 is trying to do in all this is trying to put a floor in where the tax competition is going. If you don't put the floor, then the floor would essentially go down to zero. And I doubt that zero taxes help in helping the different sectors and in providing the support that they need. What happens is that essentially the revenues for governments go down to zero, and then they cannot give enough subsidies. They have to tax other sectors of the economy. This is what we see at the macro level. So the taxes come from consumption, the taxes come from labor, and of course, there's a counter argument that this hinders growth as well. Inequality as well is one other factor that hinders growth. The governments can support the different sectors through other policies. For example, they can provide subsidies to particular policies. I've heard the argument also about linking the global minimum tax with the net zero aim, as was voiced by Samantha. I think this can be done through additional tax revenue and through financing investment to specific sectors. This what the government policy has done for many years. So giving policies to specific sectors helps more than not putting a limit to the race to the bottom. This is how I view the situation and how it could work better. Maybe I should give the floor to Bruno if he wants to comment as well.
Yes, just a quick comment. It's a very interesting question. I would say that in this discussion we have already touched what are for me the three main themes in FDI looking forward. So one is the global minimum tax. The other one is what Samantha was referring to, the green transition, the sustainable FDI, and the other one is what the question refers to, the restructuring of global value chains, and this push that we see. It's objectively like that towards more local value chains or more national policies, so sort of inward tendency from countries to retreat from globalization. Now, so my first reaction to the question is this one. Retreat from globalization comes first from sort of skepticism on the capacity of multilateralism to deliver. And the global minimum tax is a good example. With all the limits that he has and all the doubts that we can have about implementation, is a good example in the opposite direction. So a big number of countries, they decided, it's a big step toward tax cooperation. So a big number of countries decided to set a limit on the effective tax rate they can apply. So in some sense, to limit the tax sovereignty in favor of a better, more coordinated international tax system. So this is the most, I think, powerful answers we could make to these tendencies towards sort of retreating from globalism, multilateralism, and so on. Of course, there are challenges, because it's true that FDI are under pressure already, especially what we call efficiency-seeking FDI, so that are very important in Asia, for example. So adding further challenges in terms of taxation can be very challenging. But I agree with Panayiotis. The answer is not to leave in place a system that doesn't work. The answer is to set up an effective multilateral process to take care of the system. And so far, I would say that with all the limits and the challenges, the process has been able to deliver a policy answer to the big challenges that we are facing.
Thank you both. As you've both been answering that question, we've been joined by Professor Thabo. So maybe we just pause on the Q&A for a moment and go back to Professor Thabo. And Thabo, if you don't mind sharing your perspectives on the topic, and I know from our kind of earlier conversations, you're sort of whilst the focus of the seminar is Asia, but I think it is actually very interesting to understand, reactions in Africa, particularly also given the wide use of incentives in Africa and how sort of, governments and how, corporates and multinationals are responding to this development in your region. So please, over to you.
Thank you very much, Michael, and good morning, good afternoon, good evening, whichever applies to everybody over here. I am really very sorry that I couldn't join earlier, and this will talk a little bit to our resource issues in the African continent. We've got systemic power cuts that we refer to conveniently as load shedding. They're just purely blackouts where government fails to supply us with enough power. So you don't get to know in advance whether you're going to be affected or not. So just as I thought I was going to join the call, I realized that I would not have power where I was. So I had to drive to a different location in order to make sure that I've got power. So that goes to what? It goes to the challenges that a lot of African countries face, where you've got systems, but systems don't work. And when systems don't work, you fail to deliver on what you promised to do. Now, when it comes, for example, how do I link this to global minimum tax and the Globe Rules Inclusive Framework? And I would go back to BEPS on its own. The point is that there is quite a lot that we have as all countries. It's not only developing countries, but all countries have a lot on their plates in relation to tax that needs to be dealt with. Now, you'll find that developing countries have their tax systems, which tend to be complex because they need to keep up with the global trends. And then we enact a lot of anti-avoidance rules, we enact a lot of provisions that we, as countries, become unable to administer. And when they become unable to administer, the concern that comes with that is, why would we be bringing up more and more complexity, more and more rules in the systems when we are unable to administer the current ones? Would we be able to keep up with that? I'll take you back to base erosion and profit shifting. With base erosion and profit shifting, some countries like South Africa went at great lengths to try to incorporate the rules that are the global rules. And to be honest with you, some of these rules are yet to be understood. Some of the rules are yet to be implemented because purely of resource availability. There is not enough resources in the tax administrators' offices, in the tax authorities to administer some of these and to understand, implement, and administer. It's a big problem. Now, the other issue that we find is that as a result, the benefits of the inclusive framework, and I will be particular to the global minimum tax, for example, just using it as an example. African countries have gone at great lengths to understand what the actual impact of those rules are for us as African countries and developing countries in general. So, for example, we look at the logic behind them. The logic behind them is that if you, using global minimum tax as an example again, if you are to implement a rule like that, the benefit of it are said to be that you will get more revenue, you will get more tax revenue, and that developing countries benefit more. But you know, when you look at it deeper and deeper, a lot of information has been shared in terms of which we know that the US would be the biggest beneficiary of global minimum tax, for example. And that with African countries, it's so negligible that nobody even knows the numbers. Or well, some people would hazard some numbers that to us seem like a little bit of some thumbsuck, but there are those numbers. And some of the benefits or that we would be curbing the race to the bottom. Wonderful idea. But then the question is, if we are curbing race to the bottom, how are we doing that? We're doing that because in a way that we're keeping the taxes high. We're not using taxes as a competing or as a tool to compete, but African countries always ask the question, what else do we have to use as a competition tool? Well, everything else that is there, the key determinants of business, political stability, security, the currency powers, etc. We simply don't have that. And that is a fact. So if we are to compete with developed countries and we're taking away our own and the only available tool for competition in order to get into the boxing ring with persons that have more other abilities, who have more other facilities to compete, when we deprive ourselves of the only one that we have. Think about it this way. We use taxes, and I'm not going to lie about that. Incentives are prevalent, as Michael said, in Africa. We use incentives to attract investment because we don't have any other strong mode of competition. And if we take that away, the question is, what are we left with? Well, we talk about race to the bottom, and we say, well, we at the bottom in most respects, we do not find that we stand to lose a lot if we engage in that. So this is just some of the things that we need to think about. And maybe just to add one last third point is that shouldn't we, as African countries and as developing countries, look at, once, as I've talked about, strengthening our available resources, like our available taxes, tax implements, but then also maybe let us make sure that we exhaust those properly. Let us make sure that we exhaust those properly and develop tax products that would fit our countries. So in this regard, when African countries, one of the African countries that blatantly refused to adopt, for example, Pillar 2 is Kenya. And Kenya is basically saying, if we are looking at digital services as a problem, then perhaps we need a tax or a system that is specific to our problem and deal with it. And that is why they have introduced a digital services tax that applies to digital services at a low rate of below 1% of the total amount of the turnover. And that is how it is applied. And they believe, Kenya strongly believes, that that works best and it is administrable locally, etc. In addition to that, you look at our competition space, most African countries have withholding taxes that are a very strong backstop of tax incentives and low tax rates. They apply and they make it such that as a general matter, we would have at least looking at our effective statutory tax rates averaging about 30%, the application of the withholding taxes should, when properly administered, bring our effective tax rates to about 16, 17, or 18%. I think I will pause right there, lest I hog the stage. Thank you.
Thank you, Professor Thabo. Actually, it's interesting, the points that you made were dealt with in Matt Andrews' paper, and Matt was kind of making the point that sort of, globe, Pillar 2 is very sort of economic efficiency is the dominant sort of criteria driving that. And he was arguing that it really doesn't deal with or address vertical equity. And I think the example you said, what else do we have if we don't have tax incentives, in terms of competing, in terms of infrastructure and education. My apologies, I'm just reading from my handwritten notes. But Matt's paper argues that there should be he proposes a framework for qualified developing country incentive regime I was just sort of, I mean, and one of the questions I do want to ask, and I think it's just kind of timely given Professor Tabo's comments. I mean, what was the reaction from the panel to that? Maybe Professor Taba, sort of starting with you, just as a follow-on to your comments, but Panas, Bruno, and obviously others to the extent that they wanted to comment on that as well. And Sam, just for your reference, in the subsequent Q&A, Matt made the comment that it might be a bit too late for that, but then sort of said, well, maybe it's going to be relevant for things like green incentives and sort of getting in alignment in terms of sort of priorities. But I'll turn to Panos. Did you want to comment first, and then sort of Bruno? And after Professor Thabo, if you wanted to kind of comment on that proposal and how you would see that would be perhaps a good starting point.
Yeah, fantastic. I mean, as I have said, I would really say that when you have targeted particular rules that are intended to curb certain kinds of avoidance that are applicable in the countries, you achieve more than when you adopt a policy or a principle that is intended for countries that do not have the same problems as you do. Like, for example, as I say, you have African countries that still struggle to administer principles that were adopted by everybody long time ago. When you think about transfer pricing, it's still one of those difficult things to administer in the countries. So maybe it's more like a targeted solution than adopting a globalized form in respect of specific challenges per country. Thank you.
Thank you, Thabo.
Maybe if I can go next, yeah.
Please do.
So I don't know the proposal exactly, but what I can say is that we have done a lot of research on the expected benefits, especially in European countries, but also on some other countries that we have data, in order to get the expected revenue that they will have. We care a lot about the effect of the policies on developing countries and in Africa especially, and that's why in the next few years, we will be expanding also our research to the effect on developing countries. These are not European, or they shouldn't be European only US policies, Western policies. They have a global impact, and so we do want to investigate going forward the impact that they will have on different countries and different regions. For the EU, if I can give some data, we are estimating some gains of around 80 billion, and some of these, and without the carve-outs. With the carve-outs, this maybe watered down a little bit, and they go closer to 64 billion, at least the effects of Pillar 2. Some of these benefits go to countries of Eastern Europe that have significant activity there. Some of the other benefits go to countries that have headquarters of companies. In a way, we should think of a fair share going to different countries based on the activity that depends on different countries. We have also some estimates on the impact of Asian countries. For example, Singapore would be one of the biggest gainers from the reforms, close to 24 billion we are estimating, just because it has different estimates. It has multinationals based there as headquarters. But this goes to show how the reforms would impact the revenues of countries, because with the increase, countries would be able to collect, and even African countries, if they have some activity, then they wouldn't collect it at zero or at very, very low rates, but they would be able to compete not at closer to the 0 level, but closer to the 15 level at least. So we see that there is extra revenue that will be coming in the countries. Of course, later research that we'll be doing will be aiming to examine the allocation all over the globe, but this is what I can say for now.
Michael?
Oh, yes, thank you. Yes, Bruno, would you like to comment?
Yeah, just quickly react to the intervention of Professor Thabo. He raised a few points. They are all very, very important. I just want to come back on one, because it's the one that I hear more when I'm discussing Pillar 2 developing countries, and it's from my perspective, from an investment perspective, it's really the most important one. So the point is, if we don't have tax incentive, what else do we have, right? And this is really key, I think. Well, first of all, I'm not denying this. I think it's the most important. Maybe just a couple of considerations that put this a little bit in perspective. So one is, for example, that many African countries provides incentive on investment for natural resources, for example, right? So on something that they have as something unique. So there may be a little bit too much of an emphasis or an overstatement of tax incentives as a tool to attract investment. I think this is a matter of fact. Second element, often this tax geography matters. So often this tax, not always, but often this tax competition to attract investment is a competition within Africa. So it's competition with your neighbor. There is also a part of competition with Asia and Latin America, much less, I would say, with developed economies. But I mean, so you know, talking about tax competition from an African perspective is tricky, because it's like tax competition in EU is often between European countries. So so that's just to consideration to put this argument in a bit of perspective. But overall, I think it's a very important argument. But I think it should be seen as a challenge, not on the fundamental idea of the minimum tax, but as a challenge on how to support developing countries in the next 5 years, you know, to realize this transition to this new narrative and this new way to attract investment. You don't build an alternative value proposition to tax in a fortnight, and you don't build alternative assets if you don't have them. It's what Professor Thabo was saying, to attract investment in a fortnight. So we really need, and I think that institutions like UNCTAD, UN, UNCTAD, and like OECD, IMF have very, very important responsibility in that. We really need to sideline with developing countries to support them in the next 5 years, because those will be really, really challenging for all the reasons that Professor Thabo was mentioning.
Professor Taba, any reactions to?
Yes, thank you very much, Michael. And thanks, Panayiotis, for your pledge to do research to see what benefits there could be for African countries. And just back to Bruno's point, you know, we've said this before, that when people look at Africa, they see Africa as if Africa is one country. Unfortunately, there is real competition within African countries. The frustrating part, and we've had this at the South African Development Corporation level, SADC, where we try to encourage African countries to not indulge in incentives, especially where we would be competing against with each other and only with each other and nobody else because of that wealth in resources. It's a big problem. It is something that is undesirable because, you know, we go back to what Panayiotis says, that you're collecting zero when in actual fact you can collect anything. What, you know, you could collect 15, you could collect 10, but you're collecting zero because you've got that ability that you're not utilizing. So there is a drive to realize that when you've got resources, you need to utilize them very well. But there is a lot of desperation that gainsays that. Desperation that makes countries fail to properly acknowledge and analyze the ability that the countries have. So I would be very interested, Panayiotis, in finding a balance between what we could collect and keeping on being able to attract investment, because there is a lot that is stacked against African and other developing countries. And I would tell you, Asian countries must be having the same challenges. But the point is not to push this to African countries or developing countries without being conscious of the challenges that they face. So you want to be conscious of those challenges. You want to be able to work around those challenges and provide a solution that is holistic, that is all-encompassing to these countries, whilst at the same time, and as I've said before, we are working on it from the African Tax Administrators Forum to say, yes, it's a good thing to adopt, but there is also challenges within the countries where, like countries like Senegal almost immediately adopted without analysis because it seemed like a good a thing to do without looking at the challenges that it would bring. But yeah, I take the points, and I think that those points need to be repeated to a lot of our countries, both African and Asian, in order to conscientize everybody to say a good system, if well adopted, might benefit all of us.
Makes sense. Thank you all. I just linking back to some of the earlier presentations, I mean, there was a focus, Belista and Ivan sort of focused on impact on tax incentives and design incentives and policy responses. You know, Bruno, you talked about, Globe is going to have a big impact on FDI, but just sort of perhaps, again, opening it to the floor, but how should, and drawing a distinction between developing Asia versus developed Asia, how should developing Asia think about, attracting FDI on a go-forward basis? How should they think about sort of, incentives? And I think, Bruno, you were sort of alluding to, there is going to be a process, but I'm just sort of, whether maybe to start with, you wanted to sort of expand a little bit on your earlier comments, and then sort of get reactions from the others.
No, sorry, I was just going to ask, could we make, I think, Vaibhav and I possibly both had a comment on developing.
Oh, sure, certainly, yes. No, please,
we feel quite strongly about. So, Vaibhav, do you want to go first?
Yeah,
if you don't mind, Michael.
No, please go ahead. Yeah.
I'm curious to hear the point.
Yeah.
Yeah, I guess from an Asian perspective, it is a myriad of countries, right? We have like 48 countries in the region, and OECD cannot legislate or implement the laws. So their goal is to have a general consensus and among the broader inclusive framework, and then let the country by country implement the laws and treaties. So Asia being so diverse, full of emerging economies, requires different sets of social and economic policies, right? So that they can achieve their goals. And one of the things that I guess, Professor Chris has mentioned in his Asia Voices paper is that many countries in Asia do not converse in English language or in the French language. So how do they interpret the official statements, the model rules and treaties? So it could be a challenge, I guess, just to echo, Professor Thabo's point is there is challenging part for the tax administrators to have systems in place, to make sure the necessary interpretations are made, and also to have professionals who could understand, explain, and implement such concepts, either by modifying the tax rules or by overlaying on the existing domestic rules, right? So, and also the capacity in Asia is still developing. They are still getting up in terms with transfer pricing. Not to forget, India just had a universal VAT regime just 5 years ago, right? Like a universal VAT regime. So they are still developing, they are still trying to get sophisticated. So I guess the whole point being that one size does not fit all. That's what Professor Thabo is trying to make a point on.
Yeah, no, very good point. Sam?
So maybe to pick up on a similar theme. So from my perspective, the global minimum tax regime is not really a tax raising regime. It's fundamentally an anti-avoidance provision, but it's an anti-avoidance provision over governments rather than over taxpayers. So I think in the end, the countries that will raise tax out of global minimum tax are those who currently have low taxes. And I think, in fact, that's probably, if we look at the numbers, somebody with a lot more evidence-based data, I think, made the point earlier in the discussion. So when I then think about the practicality of a regime for developing countries, I sort of think of 2 points about whether the global minimum tax is the area to spend the effort on that. Because as I said, I don't think there's going to be a huge amount of tax actually raised. If we look 5 to 10 years down the line, I think individual countries will have adjusted their policy to pick up the tax domestically. So I think of 2 points. The first is whenever you come to trying to define a developing country, it always has a lot of different debate points to it. And I think you have to think about the policy objective of global minimum tax in part was to stop inversions. And a lot of inversions have happened to, in particular, Caribbean headquartered locations. So you've got to think a little bit broader globally to design something that will deliver the objectives you're talking about. But I think the second point is, if I could change one thing to make global tax work better for a developing country, it would probably be around the transfer pricing rules and how transfer pricing rules deal with the distribution of expenses. As we look at sort of a more global infrastructure supply chain, we have just more centralized supply chains. Wherever they are centralized, they are more centralized than they used to be. And therefore, you have more costs to be distributed. And at the moment, transfer pricing does not really take account of the economic purchasing power of a country in deciding how to distribute expenses. And I think if some work could be done on transfer pricing to maybe tweak that feels to me like it would deliver a bigger bang for the buck for developing countries than will come through global minimum tax, and therefore possibly is an area more worthy of the efforts of the panelists and the prior panelists. So Michael, that was I guess my last subject. Thank you for allowing me to pause us and take us backwards, which I know as a moderator is extremely annoying when people do that.
It just means I have to look more closely at the chat box as I'm going along, as opposed to being engrossed in your conversations. Bruno, just in terms of developing Asia and just kind of closing out this part of the discussion, but also going back to your comment, the impact on FDI. How do you see how do you see that sort of how do you see that impact, and also how should, particularly, I mean, not just developing countries in Asia, but developing countries generally think about this, and coming back to the broader theme in terms of a voice of Asia, voice from the ground, how as a region, how as an African region should people be thinking about this, relevant stakeholders be thinking about this?
Yeah. So I will maybe first mention how I see the general picture, and then maybe I will try to talk a little bit about developing Asia. So relative to what, for example, Samantha was just saying about you know, the challenges and what could have been done differently or better in terms of the tax design of the reform. I have an investment perspective, right? So so what I'm saying is from the perspective of investment and of countries, especially developing countries, receiving the investment, so as one important component of the economic development strategy. So from that perspective, the way we see Pillar 2 is as a powerful excuse, let's put it this way, excuse to do things that should have been done for quite a long time, and to do them quickly. No, among these, primarily the review of investment incentives. So in that sense, we see it mainly as an opportunity. But we should also recognize that it's a huge step, especially from the investment perspective, especially for developing countries. And as I was saying before, the transition phase, while they are, you know, they from here to a steady state where they will have revised their mechanism and their value proposition to attract investment will be very challenging and very dangerous, especially if this happens in a sort of uncoordinated and patchy way, with some country racing forward, some countries stepping behind. So in order to coordinate this phase, I think it's really important that multilateral processes work well. So we have done a step which is setting up a sort of largely agreed tax reform, with a principle that I think it's also largely agreed by the shareholders, sorry, by the stakeholders. But now there is a really critical phase, I think. For developing Asia, relative, for example, to Africa, right? So, so generally speaking, from a country perspective, the objective is, when talking about FDI, is to upgrade in what we call the global value chains. Many Asian countries have done this brilliantly. Others, they need to do that. What do we mean by upgrading in the global value chain? You know, moving from activities basically in the global value chain at low value added to activities at higher value added. So this is where many developing countries in developing Asia stand, and this is their objective. Is the introduction of a global minimum tax, problematic for that objective? I don't see as one of the most problematic things. It will be further pressure. It will put further pressure on FDI. It will be squeeze further efficiency-seeking FDI, because doing FDI will cost more. But I honestly don't see taxation, and this is a difference with for example, Africa and Latin America and Caribbean, as a critical elements in the strategy of developing countries in developing areas to attract FDI. It's true that it's efficiency-seeking FDI, so it's FDI with the objective of minimizing costs, but that has generally come in the case of developing Asia with leveraging labor costs rather than taxes. So in that sense, those arguments around nationalism, reshoring, relocation, regionally. These are much more problematic for developing Asia, I would say, rather than the global minimum tax, which is in any case a big thing, but not, I don't see as hugely problematic for developing Asia.
In Panos, Thabo, any quick kind of final observations on this point? Because I do want to sort of shift to multinational kind of perspective shortly. So, but any final comments on this topic or response to Bruno?
I certainly agree with what has been said. Maybe the comment that I want to make about developing Asia and the Asian region in general is that we don't know a lot yet about the implications that it will have, and we need to increase research in the area. Maybe this is something, this conference might be a start as well. Out of our data, we do have some estimates for Asian countries, but not for all the countries. We base our estimates using CBCR data, which come from the OECD, country-by-country reporting data, at the macro level as well. But as these become more available in the next few years, for example, Australia has lately voted in making this available, and the European Union, at least for companies that are operating either headquarters or subsidiaries in the EU, they will have to make this available from 2024. So we will be able to estimate better what the revenue effect at least will be for each of the countries. In terms of competition, we know that it's a very dynamic area, of course. It's not only the tax competition that matters. Most of the Asian countries have invested a lot in capital and labor, and also on the regulatory framework, which is helping companies invest there. So it's not only tax incentives that matter for their choices. I think this is the general comment that I have for the area, and yeah, I have several points, but for other issues, and maybe if we can touch upon them later.
Okay, thank you, Panos. Taba, any final points?
Oh yes, I just wanted to touch on that very important points that Samantha and Bruno raised, as well as Panayiotis, because my take is that we tend to like new products, new tax provisions, and before we even implement them properly, we bring about new ones without even going back to say how well have these operated. Like a lot of countries would have introduced transfer pricing legislation, CFC legislation. There is country by country reporting that we just spoke about now. FATCA, BEPS action plans. We've got all of these, but for me, it's like we don't assess them adequately to see if they work. And nobody can say, back to Samantha's point, nobody can say that, or I don't know if anybody can say that we have been able to use all and any tax provisions, be them anti-avoidance or taxing provisions in the country sufficiently to say that they don't work and therefore we need new products. In most instances, there are leaks. There are things that go unnoticed. There are administrative inefficiencies, and then before we even go and fix those administrative inefficiencies, we come up with new products. I am not against minimum tax or at all. I am basically saying, let's thresh out everything that we have sufficiently to make sure that it doesn't work, and therefore we require a minimum tax, considering that our problems are not the same. Yeah, I'll pause there.
Thank you, Thabo. Thank you all for the discussion. A large part of the audience is actually kind of representing multinationals or also multinational advisors. And I think Vaibhav, in your introductory comments, you talked a little bit about your process in terms of engaging with stakeholders and thinking about implementation. Sam, I know you touched on it a little bit, but just maybe as a starting point, if you wanted to, talk a little bit about, more about sort of, for a global bank, how are you thinking about this? And one of the themes through the earlier presentations was really, the complexity, the implementation challenges in practice, etc. And as you're doing that, your earlier comments sort of elicited a question from I think a fellow bank tax professional. It's in the Q&A box. I'm happy to read it out. But Samantha, thank you for sharing your views on the upcoming rules. But I ask that you share some further details on the particular aspect of the rules which give rise to financial services challenges mentioned, e.g. the bond point, and if there are obvious ways to address this in the context of the draft framework. So maybe, Sam, if you could sort of talk generally about, implementation approach for, such as for a global bank. And I mentioned before Taba arrived that he also had a bank tax background with Citibank in Africa. But then if you could sort of touch on Aaron's specific questions as well, I think that would be great. And sort of above, maybe after that, if there's other points you wanted to make, from a multinational perspective, from somebody who's going to have to implement this, across multi-regions, I think that would be, very, very helpful just to broaden out that conversation. Sam, over to you.
Thank you, Michael. So maybe to take the banking question first. So the detail of the rule that causes the issue is that banks are required to hold government bonds in order to ensure sort of liquidity resilience. So it's a part of the regulatory regime. A lot of government bonds in many countries are non-taxable. That's not really to do with the tax treatment of corporates. It's more because if you look at the typical investor in a government bond, it's typically a flow-through fund, or it's a excuse me, a sovereign fund, or a pension fund. So particularly pension funds. So they're often non-taxable just for the efficiency of the tax system. What you end up with, how the global rules were drafted, when you make an accounting loss, what the global rules try to do is to tax you on the credit, effectively the benefit that they think you're getting from the credit from the non-taxable government bonds in the period of the accounting loss. This is simple because it then means you don't have to track the usage of that loss forward to find out when you did actually use it. But obviously, if you've just made a huge accounting loss, you're in the middle of a financial stress, to be taxed on a credit for a government bond exemption that you can't use because you have huge losses and you may indeed never be able to use, is not really the right point in time to be levying that tax. There are two ways of fixing it. The first is you could just make non-taxable government bonds a good permanent difference for the globe rules. I don't think you'll find many people investing in government bonds as a sort of part of an investment strategy that doesn't require that. They are not the most exciting investment products that you can find. So I think that would work. I think more likely what will happen is that the loss rules will be fixed more generally in the framework, because I think there were quite a lot of other issues with how the loss rules worked. So I'm really expecting that to get fixed in those. So that was the more detailed question, which I hope Aaron answered the question. If I move on to more general implementation challenges, I am lucky enough to have just invested in a global tax reporting software for doing my IFRS book reporting. And that really, I think, is going to prove a very lucky, I'd love to say foresight, investment decision by the tax department, but I suspect it was a little bit of luck. But what that means is that we do have most of the data that we need in order to comply with the global minimum tax regime, and we have it in a central repository. I think for those that don't currently, the compliance costs of this regime are going to be a lot more significant. So leaving that to one side, what drives the compliance cost? I think the thing that is most going to drive the compliance cost, or the lower level, or that compliance cost being a lower amount, is really the standardization of the individual domestic qualified regimes. If the OECD keeps a firm line on that, And if countries implement domestic qualified regimes that actually mirror the global regimes, that will keep the compliance costs to a proportionate amount to implement the legislation. If we start getting variations on a theme there, the compliance costs just double, triple, quadruple. The second thing that drives compliance costs is not having the rules sufficiently in advance of the legislation actually going live, which then means that you have to build a transitional solution in order to go live, as well as a strategic solution to do it properly. You pretty much double the costs or more of any implementation, and that is exponentially goes up the closer the time goes to the legislation going live and you not having all of the guidance. So the fact that we don't yet, as we speak, have the safe harbor rules is really a fundamental driver of compliance costs. So I think those are the two things that can be done to kind of create a proportionate compliance cost outcome. But I do appreciate that I'm speaking from a slightly fortuitous position in just having rolled out some global software on book reporting. So I guess, Michael, that'd be my observation, and maybe we'll see how aligned or not that is with perspective from Jen.
Yeah. No, I think that's very good, Sam, that you've been able to implement it, and companies like ours and in the industry are still trying to figure out what's the best course in terms of reporting, data, compliances, and internal resources, right, to make sure we are able to pull together all the requirements that come about from these new rules. So I'm sure I'll reach out to you later on. I guess the couple of points that I'd like to make, and I'll keep it brief, coming up on time here, is on Singapore and the Singapore tax incentives, because the government agencies in Singapore, EDB, has emphasized their need for the continuing need of tax incentives in Singapore, and how does that impact the companies that are already in one? Because there is a need for having quantitative and qualitative investment requirements, innovation, a certain level of seniority of decision-making employees here. So now that we'll have a domestic minimum top-up tax, how does that gel with the other business costs and investments that we need to make? So that's a cost-benefit analysis that many companies in the industry will need to undertake. And to that point, I guess we heard during this seminar that some of the data that came out from the research that Mona and the EU Tax Observatory had, that Singapore is going to stand to benefit to the extent of $7-8 billion or euros. And what does it do with this? Additional revenue that it did not have before, versus the continuing need for investments, the global trading hub, the global investment hub, banking hubs, shipping hubs, So how does that work from an economic policy perspective? So those are some of the points that keep us thinking.
Michael, you're muted.
Oh, goodness, you'd think after 3 years of COVID, I'd get used to the mute button. I was going to say, any reactions from our policy friends in terms of the compliance aspect and the compliance costs, just listening to that multinational sort of in-house perspective of having to take this and implement it globally?
I just have maybe two quick comments. The first on the estimation of the gains for Singapore, that is 22 billion. Yeah, I didn't say around 70, just to be clear. But this is still quite significant. It's around 5.5% of Singapore's GDP. So it's quite a big amount of money that we expect Singapore to collect. And we will be updating also our estimates in the next few months as the new macro level CBCR data have been released from the OECD. But I also wanted to do a comment on the banks, because systemic banks in Europe is an area that we have focused on, given that they are required to publish their country-by-country, country-by-country reporting data. So we know most of their activities in different countries. And my colleagues here have produced reports on banks. What we see in regards to banks is that not all will be affected. The ones that will be affected are those that do most of the profit shifting. So they have different models, business models that they operate. A commercial bank, which is quite large and systemic, is very different from HSBC, for example. And also other banks have different models that are quite more global than domestic. We have produced a report based on what the countries release as CBCR, and we have also made the similar estimations of how they would be impacted and how much they will have to pay. And this depends very much on how much they use low tax destinations. Indeed, they are regulated regimes. It's an industry that is highly regulated, but the impact varies according to the use of tax haven to do profit shifting. And on the other hand, we have built significant resolution frameworks, at least in Europe, after the debt crisis, to deal with any kind of problems that banks would face. So the frameworks are significantly reinforced so as not to worry as much if something happens to one particular bank.
Thank you, Panos. I'm going to finish by asking each of the panel for a final observation. But before doing that, Chris, do you mind if I bring you into the conversation? And having listened to the discussion and the perspectives, what's your reaction, particularly in terms of the voice that's needed from Asia as we move forward into 2023, with the implementation process?
So, I mean, I think it strikes me that, we still aren't hearing the true voice from Asia. Today, we've had representation from, players, stakeholders in Europe, in Africa, based in London, looking at global operations. Vaibhav also deals not just with Asia, but also has responsibilities across the region. And I think, given what we've discussed, not just in this panel discussion, but also in the previous sessions, from keynote speech by Dr. Jay Rosengard to the three paper presentations, it's clear to me that I think a lot more work, a lot more research that Panos talked about is needed about the effects of implementing various tax law changes. Even implementing a QDMTT, right? Exactly how much each country would raise or not raise is still up in question, right? So I think a lot more work needs to be done, and that there still seems to be a bit of a gap in terms of capacity region-wide in terms of being able to address this. We heard similar things happening in Africa. I think we still are not at the appropriate levels to be able to do this in the region. So, it sounds like as if I'm closing the seminar, but I would say that is where I take away from today's session that there is a lot more work to be done, country by country, company by company.
Thanks, Chris. And just to close, a final observation from each of the panelists, and perhaps also, your own sort of view as to where further work is needed, particularly in terms of implementation in Asia, or in the case of Thabo, Africa. So I'll go left to right on my screen. So Sam, you're first off.
Maybe I'll use my closing comment to comment on the previous point that was made. So my point wasn't really whether global minimum tax will raise money from banks. My point was whether that could be addressed within the existing tax system, which it can be, because it could be addressed by the domestic CFC rules of the countries where those banks are headquartered, because they are all headquartered in Europe, to your point. You don't need global minimum tax to do that. You do need global minimum tax to stop people inverting out of Europe. So maybe just to clarify my point, Michael, and then I won't use more airtime in giving a summary comment.
Okay, great. Vaibhav, final observation?
Yeah, I'll just echo the points that Sam has made and Professor Chris has made. Yeah, a lot to come and a lot more challenges. So look forward to and having more white hair on me as well.
We'll check back within you next year, rather. Panos, your final observations, final comments?
Oh, I just want to say that I enjoyed the discussion a lot, because usually in the panels we get to discuss with other policymakers, other researchers, but we rarely find the opportunity to get a panel so diverse, both regionally, but also in the industries or institutions that we represent. It's just very interesting to see where we go forward, which is out of our hands. We try to influence the process, all of us, and hope to do analysis and see what we can do, how we can improve the different estimates, or how the rules apply to you in the industry. So it's just very interesting to see in the next few months and years how these turn out to be.
Thank you, Panos. Bruno?
Thank you, Mike. I join the other comments. I have 2 points. One is exactly about this. This is what we need. We need to really put together the different stakeholders, and I totally agree with Panayiotis. Probably we come from not so different angle, and it's not so common and so obvious for us to have a real open discussion, for example, with business. So this is something we really need. The second point is I think that sometimes when we do this discussion, I feel that doubts about implementation, is this going to happen? Is what prevents us to have to intensify this process and that should not be the case, I think, because in one way or another, this is here to stay. So at least on the fundamentals, we can have a discussion without feeling the risk of say wasting our time in some sense. And third, I want really to push you to when having this discussion to focus on investment as much as on revenues. Revenues and investments are two sides of the same coin in this story, and this for developing countries very often investment are almost more important. The revenues, the way they perceive it, at least. So this is my conclusion.
Thank you, Bruno. And last but certainly not least, Thabo, your final observation.
Yeah, thank you very much. And I should just start by saying thank you for having me and for the exciting conversation. It's good to know that not only African countries have these challenges and that everybody else seems to have the same challenges, but also I think that just touching on Sam's point that there might be benefits to this global minimum tax and many other things. Like, for example, I would tell you that a number of African countries like Nigeria had a minimum tax that has been repealed or is being repealed because of the complexity, and that it discourages FDI because nobody knows exactly how it works and how it works differently from the others. Global might work because everybody would kind of like understand exactly how the general rules work. So there might be positives about that. But I'm really, really happy about the diversity of views about this, and that we should keep these conversations going because we learn a lot from each other across the regions and industries. Thank you very much.
And my final comment is to thank the panel for allowing me to moderate the discussion and being able to hear such a diverse range of views. And for me, it was a very, very interesting discussion. So thank you so much for your time. And Chris, with that, I turn back to you.
Yeah. So again, I think we've heard a lot of views. The diversity is, I guess, very much a part of what we hopefully wanted to design out of today's sessions. I hope everybody has had a good sense as to kind of the challenges out there, what needs to happen over the course of the next few years on this particular point. The Asia Voices Working Group was set up earlier this year, or actually last year, to do this exactly, to gather a lot of views and to ultimately build this capacity to deal with this issue of tax equity, where governance of tax becomes front and center for everybody, not just specific jurisdictions to lead, but for how we think about where tax is being paid around the world. We have heard that there has been a dearth of voices from the region. The Asia Voices Working Group is designed, hopefully, to help in that process. So we very welcome any contributions to join the working group, or just to collaborate with the working group to develop the discussions, develop the thoughts and insights further. With that end, we are targeting another seminar like this one. It is likely to move to a hybrid model in June 2023, where we will come back and invite you all to contribute further insights, not just into Pillar 2, but to the whole BEPS initiative. So with that, may I thank Michael for very much moderating this, moderating this session. Thank you all of the panelists, Bruno, Panos, Samantha, Vaibhav, and Prof. Thabo. Thank you so much for being here at this time, even under significant duress in Tabo's case. So thank you for all of that. And thank you everybody today